Let's talk about credit scores, what's on your credit report, and how they impact the interest rate you're gonna get when you buy a home, and what type of mortgage you can get approved for due to the things on your credit report. Stick with me, Tom Kalagher, Fairhope Mortgage, and learn all about credit scores and what you can do to improve them. First thing you want to know is you don't want to miss a payment. Your payment history, paying on time, accounts for 1/3 of your total score. So being late on payments can have a huge impact. Now, the thing is, different types of being late have very different impacts on your credit score. Let me explain. The absolute worst thing you can do is be late on a mortgage payment and be late by more than 30 days. Mortgages actually are due on the 1st of the month, and on the 15th of the month is when they charge a late payment. That means they're giving you a grace period of those first 15 days. After that, you actually can still be late up to 30 days before they report you to the credit agencies. Being reported to the credit agency is the one thing you want to avoid on a mortgage late payment. So they do give you a grace period. It's okay to be a few days late, but don't be 30 days late, and certainly don't be 60. That's the worst thing you can do. The next areas we want to talk about are revolving accounts like credit cards. Revolving accounts like credit cards have a due date, and then they will report you 30 days late. You want to avoid being even a day late on a credit card for a few different reasons. The first is you're going to get a pretty hefty penalty for being late on a credit card. They're going to charge you a late fee. It could be $39, it could be more. They're also going to penalize you with interest rates. Credit cards aren't cheap to begin with. You're lucky if you're paying 15%. But if you're paying 15% and you're 1 day late, your penalty payment could go up to 29.99% or even higher on some cards. So don't be late on your credit cards. The other type of loans that you have on your credit report are installment loans. Installment loans could be things like a car purchase, maybe a boat, or it could even be a personal line of credit. An installment loan is one that's due the same amount on the same day every month. You may have a grace period on those, you may not, but you want to avoid being late, and you certainly want to avoid being 30 days late on those. Being 30 days late, they're going to report you to the credit agency, and you're going to see a pretty significant impact to your credit right away. Let's talk next about collections. So you've already been late on a card or on a car or something else, and they've sent you to collections. It could even be a medical bill that you never knew anything about. Now you've got to take care of it to improve your credit score. The first thing you want to do is you want to call the creditor, and you want to ask them, if I pay this in full today, will you completely remove it from my credit report? If they agree to do that, get it in writing and pay them immediately and get it completely off. That's going to have the biggest impact to your credit score. If they won't do that, then still pay it off, get it out of the way, and get it done. If that collection account is many years old, you might want to talk to a professional like a mortgage lender or a credit repair person, because it might be better to just leave it there. If it's many years old, paying it off could actually drop your score. If it's pretty new or a low dollar amount, I'd pay it off and get it off the credit report. Okay, so let's talk about how your credit score affects what type of loan you're qualified for. The minimum score required for FHA is actually only 500. However, there are other requirements if your score is between 500 and 580. And there can even be overlays all the way up to 600. So if your score is between 500 and 580, you can't do 3.5% down, you have to do 10% down. And you're gonna have some other requirements like having reserves, which means extra cash in your bank in case you lose your job and are out of work for a little while. They know that you can still make your mortgage payment. They're also going to want to understand why your score got to where it is and want a reasonable explanation for it. Maybe you had some medical issues, maybe you lost your job, you were late on a number of accounts over a period of time, and now you've fixed that and you're moving forward in the right direction. Your score is just low. You can get a loan. However, it gets a lot easier once you're over 580. It gets even easier over 600 and easiest once you're over 620. For FHA over 580, you only need 3.5% down. You might need some reserves. Those reserve requirements go away once you hit 600 and 620. They will want any explanations for late payments, but they're a lot more lenient than if your credit score is in the low 500s. Now, if your credit score goes from, say, 680 up to 700, that's when you start to qualify for a conventional loan. And there's some advantages to a conventional loan, like private mortgage insurance isn't needed if you have 20% down, and there's no upfront private mortgage insurance payment like on an FHA loan. It gets rolled into the loan, but it's still there. It still costs you a couple $1,000s, and it's a savings for you if you're going conventional. Conventional loans, you'll start to see the interest rates go down as your score goes up, right? So at 680, you might have one score. At 700, it goes down a little. At 720, down a little. All the way up to about 780 and above, you're getting the best rates available. You see similar things on VA and USDA loans. The credit score requirements vary on those. On USDA, you want 640 or above. On VA, there's a variety of requirements depending on some different things, but down into the low 600s for sure. But as your credit score goes up, those interest rates come down, saving you money. So all this means, the more you can do up front to increase your credit score, the better your interest rate is gonna be, the better your loan you're gonna be in, and the easier it's gonna be to get approved. So let's talk about how we're gonna improve your credit score in the months leading up to applying for a mortgage and buying a home. So now I'm thinking about buying a home in the next 2, 3, 4, 6 months, maybe even a year. There are certain things I want to do to make sure I get my credit score up as high as possible so I can save myself money. Let's talk about it. First, we want to keep our debt to income as low as possible. So what does that mean? That means that you don't want to go out and buy a new car. You don't want to go out and put a vacation on your credit cards and run up your credit cards. You don't want to take out another installment loan. And on the flip side, if you could pay any of those things off, you should do that now to improve your debt to income ratio and get approved for as much as possible when it comes time to buy the home. The other thing you want to do is you want to make sure that your debt utilization on all your revolving accounts remains low. So what's that mean exactly? That means if I have a credit card that has an available balance of $1,000, the lower I keep that, the better. So if I keep my $1,000 credit card at $999, my credit score is going to be pretty low. If I'm over 1,000, if I'm over the limit, it's going to be real low. And if I'm over the limit on a number of cards, it's going to be real low. So we want to take that $1,000 card and we want to make sure it's below 20% utilization. Now it doesn't matter if the card's got a $300 available credit or a $20,000 credit limit. We want to maintain below 20%. Now, of course, 50% is better than 80, 30% is better than 50, but your goal should be below 20. Now check out this credit card statement and I'll show you a great trick for learning how to keep that as low as possible. Okay, we're looking at a pretty typical credit card statement here. There are a few dates that you need to pay particular attention to. The first is right in the middle of the screen here, October 9th. Your payment is due October 9th. In this case, it's almost $3,500, the payment. You want to make sure that entire amount is paid on or before October 9th. If it goes over, you're late. One day over, you're late. And you could see penalties on your interest. Now, if it goes all the way to November 9th, you're going to get reported to the credit agencies. And you're going to see a significant hit to your credit. That's the first date. The next date we want to pay attention to is August 16th to September 14th. September 14th is important because it's the statement date. The statement date is the date that the credit card company will report to the credit agency. So if you pay off most of that card just before that date, when it gets reported to the credit agency, it's going to look like you're using a very small percentage of your available credit, and that's going to greatly improve your credit score. So let's talk about the ideal number of trade lines that the credit agencies want to see on your credit report. Ideally, you're going to have one mortgage, you're going to have one car loan, and you're going to have 3 to 5 revolving accounts like credit cards. Now you may have another installment account, you might have a second car, you might have a boat, you might have a second home, and there's nothing wrong with having those on the credit report. You may also have student loans on there. And the way student loans show up, even though you basically take out one student loan per year and it all gets balled into one payment, it could show up as dozens for every semester that you took out the loans. Now, if you refinanced into one loan, it'll show up as one. That's all okay as well. What you don't want to have is you don't want to have 20 different credit cards, all high limit, all maxed out. That's going to really hurt your score. Next, let's talk about medical bills. Medical bills can show up on your credit statement without you realizing it, and here's why. You go to the hospital, you go to the doctor, and you think your insurance is going to pay for something. They don't. By the time they work out insurance back and forth, you could already be 90 days late before you even get a bill. And then it ends up on your credit report and it hurts you. I see it all the time with people who pay their bills on time regularly and they get one medical bill that pops up and hurts their credit. If you get your credit pulled early enough so that there's time to review it before you want to buy a home, then what you do is you go back to that medical provider, you let them know, hey, I didn't know I owed this. If I pay this all right now, will you completely take it off my account? And they do. They almost always do. If they won't, you pay it, you move on. So you've already done credit optimization, you've done all these things, and your credit score is a little bit low. And you still want to get approved. And you talk to a credit repair person and they say, well, you can go and fight all these things that are on your credit report by disputing them with the credit agencies. You can do that. However, if the creditor has the right information and all the documents you signed when you took out the loan, they're going to send that back to the credit agency and you're still going to owe that debt. More often than not, that doesn't work. You're much better off coming up with a payment plan, working it down, and paying it off as you go. So let's touch on bankruptcies. Bankruptcies stay on your credit report for 7 years. However, the more time that goes by, the less impact they have on your score. If you make significant changes in the way you handle credit after bankruptcy compared to before, you're going to see a big improvement in your score. As a matter of fact, if you go through a bankruptcy, or if your score is low to begin with and you don't have any revolving credit cards, the best thing to do is to go out and get a secured credit card. Secured credit cards work like this. I go to the credit card company and say, hey, credit card company, I have terrible credit. I want to build my credit. I want a credit card with a $500 available balance. I'm going to mail you a check for $500. You're going to mail me a credit card that allows me to make charges up to $500, and then I'm going to pay my bill on time. And I'm going to prove to you month after month after month that I can handle my credit without going up over the limit. I'm going to pay my bills on time, and in exchange, you're going to report to all 3 credit bureaus that I'm doing a good job. And over time, over 2, 3, 4, 5 months, you can see your credit score go up really quick when you handle your credit cards in a timely manner, you pay it on time, and you're not going over balance. They can be a very useful way to boost your credit when your credit's in the 500s, the 400s, or right after a bankruptcy. All right, so you get your credit pulled and you have 0 score. There's nothing there. There's a couple reasons. One, you're fresh out of school and you don't have anything on your credit report yet. There's a couple things you could do. You do the secured credit cards and you start building every month. You charge something on it, you pay it off. You charge something on it, you pay it off. One trick is almost pay it off. Let's say it's a $500 card and you're charging up to $200 on it, or up to $100 on it. Don't pay it to 0, pay it to $5. So it shows that you're floating a little bit of money on that card, but you're keeping that payment going. Really good for the score, and in 3 to 6 months, you'll get a score at all 3 agencies. The other thing you can do is if you have a family member or a friend who's willing to add you as an authorized user on one of their accounts, we can take an account that's been established years and all of a sudden that's reporting to your credit agency. And that can give you a score in a really fast amount of time, and it can really boost your score as well. As a matter of fact, if you have children who are in high school or who are in college and want to buy a house when they're out, one of the things you can do is make them an authorized user on your cards with their consent, of course. And when they finish, their scores are going to be, close to 800 because they've been making on-time payments for the last 4, 5, 6 years on your accounts. And that's the way the credit agency sees it, and that's how their score is going to show. So you have no score and you don't have the time to do a secured card to build a score, and you don't have a family member or friend who will make you an authorized user. Is there another way to get approved for a mortgage with no score? The answer is yes. You develop your own trade lines and you show them that you've done at least 3 trade lines paying your bills on time every single month. So what type of trade lines are we talking about? Well, it could be your rent, it could be your power bill, water bill, cable bill, cell phone bill. These are the type of things that you pay every single month, you pay on time, and we can use that to show the credit agencies that you are a worthy risk, and they'll take that and they'll develop a credit score for you. We can then use that credit score to get you approved for a mortgage. You've gotten your pre-approval, you've gone under contract on your home, and you're expecting to close in the next 30 days. Let's talk real fast about the things you do not want to do in those 30 days with your credit to prevent yourself from screwing up your closing. Let's talk about the first. You were smart. You paid off your car and you didn't go buy a new one before getting pre-approved. This lowered your debt to income and it maximized your pre-approval amount. Now that you've gotten your pre-approval, now that you're under contract, you're excited to go get a new car. Maybe you want a pickup truck to help move. Don't do it until after closing. If you go buy a car, they're gonna pull your credit again right before closing. They're gonna, even if that's not on your credit report yet, they're gonna see the credit pull and they're gonna wanna know what it was and if you got another line of credit. And if you did, that's gonna go into your debt to income. It's gonna have to be calculated and it could stop you from buying your home, even if you've already been approved. Even if you've already got your clear to close and you're only 5 days out from closing and you go buy a car, it can kill the whole thing. Don't do it till after closing. The next thing, you're under contract on the house. You've seen how it's laid out. You have 4 more rooms than you used to, and you now need to go and buy new TVs, new furniture. You need to get a moving company. You need to get all these things in there. So what do? You run over to Best Buy and you put $7,000 on your Best Buy card because you need a fridge, washer and dryer, 3 TVs. Why not get the surround system? That's all gonna go on your debt to income ratio. They're gonna see the credit pull at Best Buy and they're gonna add it into your debt to income and you may not qualify anymore. The furniture is the same thing. You know that you wanna get the furniture, you know you wanna get it delivered a day after closing, and you've gotta buy it ahead of time. If you buy it on credit, that is gonna show up on your credit report. It's gonna affect your debt to income and it could affect your ability to close. If you're gonna do one of those things, reach out to your loan officer. Tell them exactly what you're planning on doing, how much you're planning on spending, and what the monthly payment is going to be. They can run the numbers and see if it's going to be a problem for you. If it's even close, just wait until after closing. It's not worth it to risk not closing on the house that you've been trying to buy for the last 30 to 45 days because you want to get a couch delivered within 1 week of moving in instead of a month within moving in. Let's talk about some tips and tricks for how to make sure you don't miss those payments. Okay. Number one, almost all of us work with a smartphone that has a calendar, or we live off of our Microsoft Outlook calendar for work like I do. If it's in my calendar, I'm doing it. If it's not in my calendar, I don't remember. Put your credit card due dates or statement dates onto your calendar so you remember to pay them. You get a reminder every month, make sure they're all in there. The next tip's even better, because the first one you're reminding yourself, the next one you can't forget. Most credit card companies, car companies, mortgages, they'll allow you to set automatic payments. If you can set automatic payments, you can't be late. On the credit card companies, usually that automated payment is for the minimum amount due. That might only be $40 or $20, but what happens is, well, I was going on a trip, I forgot I had a payment due, it automatically withdrew that $40, it stopped me from being late. Now I know when I get back and I remember, oh, I really have to pay $2,000 or I really have to pay $200, whatever it is, but I wasn't late because I paid the minimum amount automatically by enrolling in automated payments. Say you have a charge card rather than a credit card like American Express, where they expect the full payment at the end of every month. You're not limited to making just that one payment a month. Same thing with credit cards. You're not limited to making just that one payment a month. Maybe you're trying to get points to go on a trip or pay other bills, and you're putting a lot of things on that charge card. You can go in every week and make a payment. You can go in every day and make a payment. You don't need to wait for the end of the month for some big surprise where you owe $3,000 and you weren't prepared for it. Pay it off every week. Pay it off twice a week. You can do that. All right, so you've already forgotten to make your credit card payment. You got hit with a late fee, $39. Oh, it hurts. Hate to pay the $39. And you think, man, I've been a loyal customer to this credit card company for 2 years and I've never been late. You know what's worth the time? Picking up the phone, calling them, saying, hey man, I just forgot. I forgot to make my payment. I see that there was a $39 late fee added. I see that I'm getting penalized on my interest rate. Is there any way you can waive that? Do you have any forgiveness? Are you able to take that off of my account? Some do, some don't. Some say, hey, you can do that once a year, twice a year. Others, it depends on the person and how long they've been there, but it's worth the phone call to ask. By the same token, if you know you're not going to make a payment, let's say it's your car payment, you know you're going to be late, or you're $1,000 short, and you need to make a decision on what you're going to pay and what you're not going to pay. First of all, don't ever let it be your mortgage that you're late on. Pay the mortgage. Second, you could be late on one bill if you're late on a car payment, or 6 bills if you're late on the credit cards. So do this. Call the car company, call that other installment loan, and ask them, hey, I'm going to be late. I know my payment's due on the 15th. I'm getting paid on the 21st. Can I set up a payment plan to pay you on the 21st, the day I get paid, and will you not report me as late and not charge me a late fee? A lot of them will. A lot of them will set up plans for you. It's always better to call them than not. And if they're calling you, answer your phone. Don't let it go to voicemail because you know it's late. You can set up payment plans with them. They'll work it out. It's always better to talk to them. Hopefully, if you learned some good tips on how to improve your credit and reduce your expenses by optimizing your credit. If you want to learn more, call me, Tom Kalagher, Fairhope Mortgage. I'll help you get approved.